SaaS metrics can feel very overwhelming, but here's the good news. You don't actually need to know all of them. In this video, I'm going to walk you through the 12 most important SaaS metrics organized into 4 categories. These are the ones that I've seen matter the most in over 10 years working in tech. So whether you work in SaaS, want to break into the industry, or you're building your own SaaS product, understanding these metrics is critical. Let's get into it. Let's start with the first category, growth metrics. These metrics tell you if your SaaS business is growing and by how fast. The first one is annual recurring revenue. ARR is like the lifeblood of any SaaS company. It shows how much predictable subscription revenue you expect over the next 12 months, assuming no new sales or cancellations. You'll want to track both the ARR amount and the growth rate over time. For example, Adobe, the company that makes Photoshop and creative tools, reported $2.2 billion in ARR at the end of 2024, and they have been growing at about 15% a year, which is impressive for their size. A closely related metric is monthly recurring revenue. MRR is ARR divided by 12. It's more granular and useful for short-term tracking, especially with monthly contracts. Think of ARR and MRR like pounds and ounces. They measure the same thing, just in different units. The next big growth metric, especially in B2B SaaS, is bookings. Bookings represent customers' commitments to spend money with you in the future. In enterprise SaaS, these are often one-year contracts, and bookings are typically measured in annual contract value, or ACV. There are 2 types of new bookings: land bookings from brand new customers and expand bookings from existing customers. Expansion can happen in 2 ways: upsells or cross-sells. Upsells means selling more seats, licenses, or a higher tier plan, like Zoom selling you more licenses or upgrading you from a pro to a business plan. Cross-sells involve selling entirely different products, like Salesforce selling you Slack or Tableau. In any case, new bookings increase your ARR and grow your existing book of business. The third important growth metric is customer count. The number of customers you have is a powerful sign of momentum. Let me give you a real-life example. Freshworks is a SaaS company that offers cloud-based customer support tools. They grew from 30,000 customers in 2019 to over 50,000 in 2023. At the time, Freshworks had more than $500 million in revenue, which means that they were earning more than $10,000 per customer on average. They also had nearly 20,000 customers spending more than $5,000 and more than 2,000 customers spending more than $50,000. Tracking both your total customer count and how many of those are high value accounts give you a much clearer picture of business strength. If you're in a market with hundreds of thousands of potential customers, but only a few hundred today, that is a lot of runway to go. The next category of metrics is retention. Once you have customers in the door, the next question is, are they sticking around? Retention metrics help you measure how much of your existing business is staying with you over time. The first and arguably most important retention metric is NRR, or net retention rate. NRR tells you how much your existing customers are spending now compared to a year ago. What makes NRR so powerful is that it combines 3 dynamics into a single number: expansion, when customers upgrade or buy more; contraction, when customers downgrade or reduce spend; and churn, when they cancel altogether. Let's say your customers were spending $100,000 a year, and today those same customers are spending $150,000. That means your NRR is 150%. When your NRR is above 100%, your existing customers are increasing in value over time. You're not just retaining them, you're growing them. If you're building a SaaS company, a high NRR is one of the strongest signs of product market fit. It means customers like what they're using, they find it valuable, and they are happy to pay more for it. A related retention metric is gross retention rate, or GRR. It is similar to NRR, but with one big difference. It excludes expansion. GRR only accounts for contraction and churn. So if a customer downgrades or cancels, GRR captures that. But if someone doubles their spend, GRR ignores it. It's a tougher, more conservative metric. Because expansion is excluded, GRR cannot go above 100%. Most strong SaaS companies aim for 90% or higher. If your GRR is dipping into the 70s or the 60s, it could mean poor onboarding, weak product engagement, or customers just not seeing enough value to stick around. The third key retention metric is renewal rate. Unlike GRR, which looks at all the customers from a year ago, renewal rate only focuses on the customers up for renewal. Say you have a total of 4 customers and 2 of them are up for renewal this quarter. These 2 were spending $100,000 before and now they are renewing at $85,000. Then your renewal rate is 85%. It's a pulse check for how well you're retaining customers who are actively making a renewal decision. A low renewal rate means a leaky bucket. You are pouring in customers at the top but losing them out at the bottom. Companies typically track renewal rates in 2 ways: dollar-based renewal rate based on revenue and count-based renewal rate based on the number of customers. Looking at both gives you a fuller picture of customer health. Say you might be keeping 90% of customers, but only 75% of revenue. That would suggest that some big accounts have churned while the smaller ones have stayed. A closely related metric is churn rate, which is simply the inverse of renewal. If your renewal rate is 85%, then your churn rate is 15%. If so far this has been the most helpful SaaS metrics video you've ever watched, go ahead and hit the like button so that more people can find this. And if you want more SaaS business content that's straightforward and actually useful, take a second and subscribe. Thanks for your support. I really appreciate it. Now, up to this point, we've talked about growth and retention, but what also matters is whether the entire business model is working. The third category of metrics is unit economics. It's trying to get at, are we making more money or burning cash on each customer? A key metric is lifetime value, or LTV. LTV tells you how much profit you expect to make from a customer over the relationship with your business. Now, not all customers behave the same. Some grow over time, some stay flat, some fluctuate, and some churn. LTV takes into account the average of all of your customers. It helps you understand how valuable the typical customer is. For example, if the average customer brings in $10,000 a year and sticks around for 5 years, then their LTV is $50,000. That is a simplified view, of course. In real life, companies segment customers by cohort, grouping them by industry, size, age, and acquisition channel. Now, a common question is, does churn impact LTV? And the answer is absolutely. The higher your churn rate, the shorter your average customer lifetime, which means lower LTV. And the opposite is true as well. Lower churn leads to longer lifetimes and higher LTV. Another key unit economics metric is customer acquisition cost, or CAC, which always reminds me of a keg of beer. This is probably just me. CAC measures how much you spend to acquire a new customer. It includes all of your sales and marketing costs, like salaries for your sales and marketing teams, pay ads and campaigns, events and sponsorships, and tools like Salesforce. Say you spend $1 million on sales and marketing in a quarter and bring in 100 new customers, your CAC is $10,000. As an example, when HubSpot went public, they reported that their CAC was about $12,000 per customer. One of the most classic SaaS unit economics analysis is the LTV to CAC ratio. It tells you how much return you're getting for each dollar spent on acquiring a customer. Think of it like this. LTV tells you how much a customer is worth, and CAC tells you how much it costs to get them. You put them together, this ratio answers one critical question: is your business model sustainable? Here's how to interpret it. 4 or more is world-class. Investors love it, and companies will be very happy to share that. Vimeo, the video company, once shared that their LTV to CAC was close to 5. The data company ZoomInfo once reported their ratio was over 10. But a ratio of 3 to 4 is still very solid. You are in a very good spot. A ratio of 1 to 3 usually means that there's room for improvement. You might have to bring your customer acquisition cost down or increase LTV through better retention or expansion. Below 1 is the danger zone. Maybe it's time to panic a little bit because you are spending more to acquire customers than you are getting back. Now, to be fair, early stage startups sometimes operate below 1 during the aggressive growth phases, and that's okay for a while, but long term, this is not sustainable. A company in that position will have to improve that ratio or it won't survive. To wrap things up, let's cover the last category of financial metrics. These metrics are especially important if you are talking to investors, prepping for a board meeting, and assessing how sustainable your business is. We'll start with the one that matters more to early stage companies, cash burn and runway. If you're running a startup or a growth stage SaaS business, this one is about survival. Cash burn is how much money you're losing each month if you're not yet profitable. Runway is how many months of cash you have left at your current burn rate. For example, if you are burning $1 million in a month and have $12 million in cash, that gives you 12 months of runway. This metric is critical for you to know when you'll run out of cash if things stay the way they are. The next metric is operating margin. As your SaaS business matures, the focus shifts from survival to profitability. Operating margin measures how much of your revenue is left after covering all your expenses, salaries, cloud hosting, research and development, customer support, and sales and marketing. In plain English, operating margin means after all the bills are paid, what percentage of revenue is left as profit. A positive margin means that you are operating profitably. A negative margin means that you are spending more than you are making. For example, Adobe reported a 34% operating margin in 2024, which means for every $100 of revenue, they are keeping $34. Today, profitability matters more than ever. The mindset in SaaS used to be grow at all costs, but now investors expect sustainable growth, not just revenue expansion. The last classic SaaS financial metric that investors often look at is the Rule of 40. It's a simple but aspirational benchmark. It assesses whether a SaaS business is striking the right balance between growth and profitability. The formula is revenue growth rate plus operating margin. That gives you the Rule of 40 score. If your total is 40 or above, you are considered by investors to be financially robust. If it is below 40%, it means one of two things. You are growing fast but still losing money, or you're profitable but not growing fast enough. For example, Snowflake once reported 70% revenue growth along with a positive operating margin, far exceeding the Rule of 40 threshold. But now in a tougher environment, a lot of companies do not meet the Rule of 40. So there you have it, the 12 most important SaaS metrics across growth, retention, unit economics, and financials. In the description below, I've included a link where you can download the cheat sheet for all the metrics we talked about. If you found this helpful, hit that like button so that YouTube can show it to more people. What other metrics are important to you? Drop it in the comments. I'd love to hear what you are tracking. Thanks for watching, and I'll see you at the next one.